Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Craig Erlam on the line. He's a market analyst at Alpari, calling us from across the pond. Craig, how you doing? I guess it would be this afternoon.
Hi, Joe. I'm very good. Thanks for having me on. Hope you guys are all right as well.
Yeah, we're doing fine here. So let's just talk about the ECB a little bit. Draghi still, coming forth with his plans for QE. Germany kind of dragging their feet here. What's your outlook on QE for the ECB?
I don't really see it as a likely outcome, if I'm perfectly honest. And I know it's been discussed about so much in the markets and in the media recently as being really, firstly, the only thing which traders and investors will accept as being a solid solution to this disinflation or potential deflationary scenario. But then I think when it comes to the ECB, they've got a lot more issues than maybe the US, the UK, the Bank of Japan had. I think the foremost issue that they really have is the lack of a euro bond in which to buy. With the UK, they could buy the gilt. The US, they could buy treasuries. But with the eurozone, it becomes a lot more complex when you've got so many different bonds. It's some investment grades, some not. Different sized countries. How much do you buy of each one? There's also the argument politically about whether it constitutes fiscal funding as well. So I think the amount of complications which comes with quantitative easing in the eurozone makes it less likely that it's actually going to happen. And I think what we will probably see from the ECB is more of what we've seen already, which is alternative attempts to bring some inflation back to the euro area. We've seen asset-backed security purchases. We've seen the end of sterilisation of bond purchases. We've seen interest rate cuts, negative deposit rates. There's been talk of corporate bonds purchases as well. I think this is more likely to come before we see quantitative easing. I think QE really will, if we do ever see it from the ECB, really will be a very last resort.
Okay. Now, earlier or on Sunday, the Swiss had the referendum on whether or not to up the percentage of the gold supplies from 7% to 20%. I saw the Swiss National Bank president, I believe Thomas Jordan, wasn't real gun ho on that. Did that referendum really ever have a chance of passing?
Well, I mean, if you look at the numbers, it doesn't look like it did. I think it was very comfortable win against these goal purchases. But I think it would have just caused too many issues, and I think that's why personally I don't think it ever really had a chance of passing. For one, it's not just about how much gold they own, but then that would impact the ability for the Swiss National Bank to actually maintain that floor with the euro. It's the floor with the euro, 120 is something that a level they've been trying to protect for a few years now. The euro was so weak that it was actually damaging the Swiss economy in terms of its ability to export because the Swiss franc was becoming so expensive. So for a long time now, we've seen the Swiss protecting the floor which they implemented at 120, and the euro against the Swiss is actually trading at those levels now. And the problem that the Swiss National Bank would then have had if they then had to buy all this extra gold to up their gold holdings to 20% is they may not have had the reserves which would have enabled them to actually maintain this floor. So they could have caused a lot of turmoil in the markets. It could have caused a lot of issues for the Swiss economy. And for that reason, I think there was never any real chance of it actually happening.
And what about the corresponding move in the gold market? Opened lower, continued lower, and it just looked like we were going to barrel down, take out that 1131, low of the move, caught a bit ahead of it, and then it was just off to the races here. Nearly an 80-point rally. Now we're back above 1200. You think gold has finally stabilized and found a bottom?
Well, I'm not necessarily convinced it's found a bottom. I think there is some in when we're talking in the longer term. So if we're talking towards the end of next year, going into 2016, even I think we do still have a lot more downside to come in gold. But I think, as you've said, I think one thing that we have seen is it's stabilised. So I think we're going to see a lot of range trading, I'd say, to come. I was surprised that it didn't break below those lows, 1131. But I think it is only a matter of time. At the same time, I think there's this dollar strength is going to really hamper any upside in gold. Obviously, the stronger the dollar gets, the cheaper commodities become. So I think this is going to be one of the main reasons why we are going to see some weakness in gold in the next couple of years, and especially considering a lot of people believe that this dollar rally, this dollar bull market, is only just beginning. And if that's the case, again, that's going to weigh on gold prices.
Okay, and what a move in oil here. OPEC deciding not to curb production, which is really no big surprise. I mean, they probably have the lowest production cost of any of the major oil producing countries. You got that dip down to under $64. We're able to recover here. It's just kind of a dead cat bounce in the crude oil market.
Yeah, the oil market has become a particular favourite of many traders at the moment, and there's just so much going on there that I think the situation we've really got here, as you've highlighted, is the fact that there's almost an oil price war going on. Neither side, neither the US or OPEC, want to give up any market share, and I think this is the biggest problem which they now have. I say it's a big problem for them, but it's a great problem for everyone else whose prices at the pump will hopefully come down as a result of this, which can actually act to stimulate the global economy. So people talking about oil prices falling as being a sign that the global economies are slowing, it's only really half the story. Part of the reason, of course, is going to be falling demand in China. Part of the price, of course, is going to be falling demand in the eurozone. But I think a large part of it is the oversupply. And while OPEC are going to continue to try and maintain its market share, and you've still got Russia and the US trying to gain market share as well, I do think oil prices are going to have to fall further. I think until we start to see them reach towards those $50, $40 levels, I think that's when the panic mode's going to set in, and I think that's where we'll start to find a flaw.
Wow. So you think that it could really get that low?
Well, I mean, you should never say never in the markets, especially when it comes to such major powers fighting it out for market share. But I think OPEC have really made a statement here by not cutting production. I think if they were really panicking at these levels, around this 70, 80 level, I think we would have seen a cut in production. The fact that they are holding their own and refusing to cut production, there's no way that the US are going to cut production at this stage. There's no way that Russia were going to cut production either. So I think with all this happening and with other countries as well starting to up their production as well, there's the only way is down right now, unless someone backs down. And at this stage, no one's looking like backing down. And based on that, there's no reason why it can't go further.
Okay, and Russia, where does this put them here? I've read stories that they need $80 barrel to break even, well below that level, putting a lot of pressure on the ruble. Putin calling for demands to dump the U.S. dollar, a little economic warfare. Do you think that I think that the problems that are going to be taking place in Russia are going to be spilling over into the global economy?
Well, Russia's certainly in a lot of trouble right now. The fact that yes, oil prices are now below the production cost, which I think is a big problem. Then you've got the impact on tax receipts. You've got the weakness in the ruble. I think the biggest problem facing Russia right now actually is the fact that this weakness in the ruble and what impact it's going to have on their economy, and the fact that we're seeing these constant rate increases in order to try and offset this inflation is the fact that inflation isn't slowing. There's such a massive inflation problem occurring in Russia right now, and again, unfortunately, due to the fall in oil prices and due to the decline in the ruble, I don't really see this changing at this stage, and the central bank's action seems to have very little impact on this. And again, I think inflation more so than any other macro or any other issues. So when we're talking about these relations with the US, relations with the eurozone, I don't. I don't really think Russia really has a leg to stand on right now, and I think the relations with the other areas of the world is the least of their concerns right now because their economy at home is the biggest issue, and this is the thing that's really going to impact Putin's stance on his policy with the US, because he's got so much support right now, which is enabling him to really push the barriers. But what we could see now is with inflation becoming such a problem, he may start to lose some of this support at home. So he may start to lose his ability to really push the boundaries with other countries as well. So I think Russia's going to become an increasingly interesting story because they do have many issues facing them right now.
Okay, and just any final comments on Japan making their move toward monetary policy? They have an election coming up. Is there anything that could be done to pull Japan out of the doldrums?
Well, personally, I don't necessarily think it's as bad as people are making out. People seem to be surprised that the country fell into recession after increasing its sales tax. But let's look at last time they increased the sales tax up to 5%. The country fell into recession. They had two successive quarters of contraction. I don't know why people were expecting this to be any different. We saw the first quarter when there was a massive increase in spending, people getting those last-minute deals in before prices rose, and we saw a very strong first quarter. Then we saw a very weak second quarter. I don't know why people were surprised that we were going to see a weak third quarter as well. I think it was the right decision for them to put off the next sales tax hike to 10%. They've put that off now for a couple of years. I think that was the right decision. It was the right decision of the Bank of Japan to undergo a second bout of monetary easing, increasing the asset base to 80 trillion yen per year. And so I think on both sides a lot is being done to try and bring some growth and hit that inflation target. And yes, I think it's going to take a little bit longer to hit those targets than they initially hoped for. But I think the right moves are being made, and I personally think there is no in a year's time we're not going to be worrying about this country falling back to a period of deflation where it was. I don't think we're going to be worrying about these ultra low growth rates. I think we're going to be talking more positively about the Japanese economy, and I think that's why people are so happy. Aside from the fact that we've got this ultra loose monetary policy, this is why people are so bullish Japanese stocks right now.
Okay, and just final outlook for the U.S. market. Majority or all the gains for the market coming in the last 6 weeks off the Ebola lows here. I don't know how that sets things up in your opinion for a Santa Claus rally, but just words of wisdom for investors heading into the end of the year.
Well, we're certainly seeing kind of leveling off to an extent in the U.S. markets. I'm looking at the S&P now, and when we are seeing strong gains, we are starting to see these gains are weaker, and we're seeing bigger pullbacks. But I am still bullish U.S. markets as long as we've got this ultra loose monetary policy coming from other areas of the world. It's almost with the U.S. I think they've got both ends, both sides really supporting them. They've got ultra loose monetary policy from the ECB, ultra loose monetary policy from the Bank of Japan, loosening monetary policy in China. We've still got loose monetary policy in the UK. And this is at a time when they're looking to raise interest rates, and people aren't worried about that because of what's going on in the rest of the world. At the same time, they've got an economy that's continuing to get stronger. We've got unemployment coming down. Outlook for the US economy for the next 12 to 24 months is extremely strong. So when you've got a strong economy and loose monetary policy everywhere else, that suggests that the markets are going to continue to climb higher. And I think the last 6 weeks of the year are going to be the next 6 weeks, sorry, are going to be quite strong.
Okay, Craig Erlam. He's a market analyst at Alpari. He's joining us on Benzinga's pre-market prep, brought to you by MarketFi. Craig, thanks. We covered several subjects in a very quick manner there. Thank you very much. Have a good day. We hope to speak to you soon.
Thanks for having me on.